not slowing down. Shanghai silver vaults didn't lose 195 tons last week because of one big order. They didn't lose nearly 500 tons over 3 weeks because of a holiday. They didn't drop to just 31.9 million ounces because of a clerical mistake. And this isn't a random shock to the system. This is what happens when the world's largest physical silver market keeps pulling metal off the shelves faster than the system can refill them. 195 tons in 1 week, the biggest weekly drop since January of 2024. 3 weeks of drops totaling nearly 500 tons. That's over 16 million ounces gone in 21 days. And the vault is now sitting at just 992 tons, below 1,000 tons for the first time in 7 months. We are watching the world's largest silver storage hub run down to its operating floor in real time. Silver just rebounded to $76 after testing $74 support. The 30-year Treasury yield just cleared 5%, the highest level since 2007. April CPI just printed at 3.8%, above forecast. Ground beef prices just crossed $7 a pound for the first time in American history. And while all of those headlines were grabbing attention, the most important number in the entire silver market, the size of the Shanghai vault, kept dropping. Welcome back to the macro mirror. In this breakdown, I'm going to walk you through exactly what's happening inside Shanghai's silver vaults with the actual weekly outflow numbers from independent tracking. I'm going to explain why a vault drain at this pace has consequences that go beyond China, including for the silver you can buy at your local dealer in the next 90 days. I'm going to give you the historical pattern from previous physical squeezes, what happened in 2011 and 2020 when vaults bled out at similar speeds. And I'm going to give you the 4 signals that will tell you whether this drain is heading toward a real supply crisis or whether the system finds a way to refill before it breaks. Quick favor before we go further, subscribe. If you want clean breakdowns when physical markets break in real time, not hype, not cheerleading, just the mechanics, hit the bell. Vault drains don't announce themselves through press releases. They announce themselves through weekly outflow numbers most retail investors never see. Let's get into it. Let me start with the actual numbers. Because the Shanghai vault story has been told carelessly, and the real version is even more striking than the headlines. Hugo Pascal at Improved, an independent firm that tracks physical precious metals flows, reported the most recent Shanghai data. The Shanghai silver vaults just shed 195 tons in a single week. That brought total holdings down to 992 tons. In ounces, that's 31.9 million ounces of silver, sitting in storage for an entire country of 1.4 billion people. For the industrial backbone of global solar manufacturing, for the supply chain that runs through every electric vehicle made in Asia, 31.9 million ounces. To make that number real, the global silver market consumes roughly 1.2 billion ounces per year. China alone refines about 65% of the world's silver. The Shanghai vault, holding 31.9 million ounces, is less than 2 weeks of global consumption sitting in storage. It's less than 4 weeks of Chinese industrial consumption. It's the kind of inventory level that supply chain managers describe as just enough to keep the lights on. Now look at the trajectory. 3 weeks ago, the Shanghai vaults held 1,141 tons. 2 weeks ago, after a 146-ton outflow, they were at 1,012 tons. Last week, after another 175-ton outflow, they sat at 1,012. And this week, after 195 tons walked out the door, they're at 992 tons. The drain isn't slowing down, it's accelerating. And here's the part the financial press isn't connecting. While Shanghai has been bleeding, COMEX has been bleeding too. The major U.S. silver exchange recorded 14 consecutive days of outflows back in October 2025, totaling 33.9 million ounces, over 1,000 tons gone. In February of this year, COMEX registered silver dropped below 90 million ounces for the first time in years. Today, it sits at roughly 79.88 million ounces. Coverage ratio at 13.4%, the 7th straight month below the 15% stress threshold. 2 different markets, on 2 different continents, both running down their physical inventories at the same time, and both happening while paper silver futures stay relatively contained at $74 to $87. The futures market is showing one story. The physical market is screaming another. So here's the first lesson. When 2 of the world's 3 largest silver storage hubs are losing metal at the same time, the math is not complicated. Either the system finds new physical supply quickly, or the paper price has to rise to a level where existing holders are willing to sell. There is no third option. The vaults can't be refilled by hope. They can only be refilled by metal or higher prices. Let me get more concrete about what this looks like inside the system, because vault drain sounds abstract until you understand the human chain that makes it happen. Picture a procurement officer at a solar panel manufacturer in Jiangsu Province, China. Monday morning, May 12th, 2026. She arrives at her office and pulls up her supplier database. Her factory needs 2.3 million ounces of silver paste over the next 90 days to meet its production schedule. She normally sources from 3 different refineries, all of which draw from the Shanghai vault network for delivery. She calls her primary supplier at 9:47 a.m. Shanghai time. The conversation lasts 8 minutes. Her supplier explains that available silver for May delivery is limited. He can provide 600,000 ounces. The other 1.7 million she needs would have to come from elsewhere, possibly imported, possibly through different channels, possibly at premiums above the SHFE benchmark. She asks about the second supplier. Same story. Limited availability, premium pricing. She calls the third. Same story. She hangs up. She has a procurement meeting at 2 p.m. She has to explain to her boss that the company faces 3 choices. They can pay the premium and protect production, which damages quarterly margins. They can reduce production by 15%, which damages quarterly revenue and breaks contracts with downstream customers. Or they can wait for prices to come down, which carries the risk that they don't come down before her production schedule completely breaks. She picks the premium option. The factory pays SHFE plus 2.8% for the additional ounces. The cost gets passed up the supply chain. Within a month, that decision is repeated by procurement officers at dozens of other Chinese manufacturers. Within a quarter, the rising premium becomes visible in the data Improve tracks every week. The vault keeps draining because someone has to be paid extra to release the metal. That conversation is happening all across China this month, not in press releases, in quiet procurement meetings, with cumulative effects that don't show up in retail headlines for weeks, but show up in the weekly vault data within days. The 195-ton outflow last week is the visible signature of these procurement decisions adding up. So here's the second lesson. When industrial buyers are paying premiums above benchmark to secure physical metal, the vault drain is structural, not speculative. The price has to rise to clear the market. The only question is whether it rises through the paper market catching up to physical reality, or whether the gap between the two continues to widen until the system itself has to be reset. And here's the part that connects this directly to your daily life. The same dynamic that's draining Shanghai's vaults is the same dynamic driving up your costs at the grocery store, your mortgage rate, and your car loan. Ground beef just hit $7 per pound for the first time ever. The 30-year Treasury yield just cleared 5%, which means new mortgage rates are pushing above 7.5%. The Federal Reserve says inflation is moderating, while a family of 4 feeding itself on basic groceries is now spending 40 to 60% more than they were 5 years ago. The connection is the dollar. When the dollar's losing purchasing power faster than the official statistics admit, 3 things happen at the same time. Foreign buyers want more dollars to give you the same amount of metal. Bond investors want higher yields to compensate for inflation risk. And consumers pay more for everything that's produced abroad, or that depends on global commodity prices. The vault drain in Shanghai, the 5% Treasury yield, and the $7 ground beef aren't 3 separate stories. They're 3 different parts of the same story, viewed from different angles. When the Doom Niche channels show you the vault drain as a precious metals story, they're missing the bigger picture. The Shanghai vault is the cleanest data point we have for what's happening to the dollar. The bond market is the second cleanest. The grocery store is the third cleanest. All 3 are telling you the same thing. The dollar is being repriced, capital is rotating, and silver is one of the assets capital is rotating into. Now let me put the historical pattern under a microscope, because we've seen vault drains like this before, and the outcome has been specific. In late 2010 and into early 2011, COMEX silver inventories drained at unprecedented speed. Registered silver went from over 100 million ounces in mid-2010 down to under 30 million ounces by April 2011. The drain coincided with rising industrial demand from emerging market electronics manufacturing, growing investment demand from a post-financial crisis dollar weakness story, and increasing concerns about paper versus physical disconnect. Silver, which had been trading around $20 in mid-2010, ran to $49.20 by April 2011. The vault drain didn't cause the rally. The vault drain was the warning signal that the rally was coming. Anyone watching weekly inventory data in October 2010 had a 6-month head start on the move. In March 2020, during the COVID crisis, silver inventories at major exchanges drained at extreme speed as industrial users hoarded physical metal during the panic. The gold-silver ratio spiked to 125 to 1, the most extreme silver undervaluation in modern history. Then, within 5 months, silver had doubled. The vault behavior was the leading indicator. The price behavior followed. In October 2025, Shanghai silver vaults experienced their largest weekly outflow ever recorded, 257 tons in a single week, dragging inventories down to just 6,683 tons or 21.3 million ounces. That was the lowest level in 21 months at the time. In the 4 months that followed, silver ran from approximately $32 to $121.64, the all-time high, a 280% move. The vault drain in October was the warning. The price move was the consequence. Now Shanghai is back near those crisis levels, 992 tons today, less than 30 tons above the 2025 record low of 663 tons. The data is publicly available. The pattern is documented across multiple cycles. The mechanism is the same. Industrial buyers are pulling metal off the shelves faster than the system can refill them. The paper price hasn't caught up yet. It usually doesn't catch up until the gap becomes embarrassing for the financial press to ignore. Peter Schiff captured the dynamic in a recent interview when he said, "Treasuries are breaking down. A bond market crash is the most bullish thing that can happen for precious metals. Traders just haven't figured that out yet. The bond market is signaling sustained inflation. The Shanghai Vault is signaling structural physical demand. Both are pointing the same direction. The silver price is the one piece of data that hasn't fully repriced yet." And let me give you the bear case fairly, because intellectual honesty separates this analysis from the noise. The bear case is real and worth considering. UBS recently cut its year-end silver target to $80, citing concerns about industrial demand destruction if the global economy enters a stagflationary recession. Bart Mellick at TD Securities has the lowest forecast on the LBMA analyst panel at 44.25 for 2026, basically arguing the entire 2025-2026 rally was speculative excess. The Reuters poll of 30 analysts produced a median of $79.50, essentially flat from current levels. The substitution risk is real. LONGi Green Energy is launching copper-based solar cells in Q2 2026 that use less silver per panel, and semi-solid batteries don't require silver at all. These are real arguments. They might be right. The most bearish technical analysis points out that silver has tested the $80 to $80 zone repeatedly and failed to break out, with the 50-day moving average actively capping rallies. What the bear case doesn't disprove is the vault drain itself. Industrial users paying premiums above benchmark are not behaving like buyers worried about demand destruction. Vault inventories dropping 195 tons in a single week is not the behavior of a market with excess supply. The premium structure in Shanghai trading 2.5% above LBMA is not the price action of a market about to crash. If Bart Mellick is right about $44 silver, he needs to explain why the physical market is paying premiums and draining vaults. The structural data doesn't currently support the deep bear scenario. So ask yourself, when Shanghai vaults are at 992 tons and falling, when COMEX coverage is at 13.4%, when industrial buyers are paying 2.5% premiums to secure delivery, when the 30-year Treasury is signaling sustained inflation, when ground beef is hitting record highs, and when the historical pattern shows vault drains preceding major silver moves by months, what does the current $76 silver price represent? An overpriced metal vulnerable to demand destruction, or a market where the paper price is structurally lagging the physical reality? Now let's read the current action like a forensic report. The forensic case for continued tightness is built on signals all pointing the same direction. Shanghai vaults have lost over 500 tons in 3 weeks. COMEX registered silver is at multi-year lows. Premiums in Shanghai have flipped positive again, trading 1.5% to 2.5% above the LBMA benchmark. EFP spreads, the differential between exchange for physical contracts, show near-dated months in backwardation, while further dated months are in contango. That structure tells you the market is tighter now than it expects to be in a few quarters. Holders of deliverable metal are being rewarded with premiums. The arbitrage that should normalize the system isn't operating. You would also expect, in a market where the vault drain was easing, for institutional silver forecasts to be revising downward. They aren't. Bank of America's bull case remains at $135,309. Citi's stress targets at $150, $170 are intact. Michael Oliver's framework at $300 and $500 hasn't changed. The institutional bull voices are reading the same vault data and arriving at the same conclusion. The bear voices are louder, but increasingly isolated to forecasters whose models don't track physical flows. So here's the cliffhanger. The Shanghai Vault at 992 tons is the leading indicator. The COMEX coverage at 13.4% is the secondary indicator. The premium structure is the confirmation. The price hasn't repriced yet, but the data is in place. The historical pattern from 2010, 2011, and from October 2025 shows vault drains preceding major price moves by weeks to months. The question is not whether the price catches up. The question is whether it catches up this quarter, in summer, or by year-end. Let me put the macro context around it. Because the vault drain doesn't happen in isolation. Gold is at approximately $4,794. Central bank gold buying continues at structural 850-ton annual pace. The Federal Reserve voted 8-4 on April 29th with 4-direction descents, the most fractured FOMC vote in 50 years. Kevin Warsh just confirmed 1311 on partisan lines. the first ever in committee history. The 30-year Treasury at 5%, April CPI at 3.8%, fiscal deficit at $2.065 trillion, ground beef at $7. China's silver export restrictions still in place. The structural drivers across the entire macro landscape are pushing the same direction. Here are the 4 signals that matter more than any forecast you'll read this week. 1. The weekly Shanghai vault data, currently at 992 tons. Watch for the next weekly report. If outflows continue at 150 plus tons per week for 3 more weeks, the vault will be below 600 tons, testing the October 2025 record low of 663 tons. That breach would historically trigger acute price response. The data is published weekly by Improved and other physical market trackers. 2. The Shanghai LBMA premium, currently at 2.5%, or about $1.20 per ounce. Watch for the premium to widen toward 5% or higher. That would signal the arbitrage system is breaking down further. The premium narrowing toward 0 would suggest the drain pressure is easing. The level matters more than the direction over the next 90 days. 3. COMEX registered inventory, currently at 79.88 million ounces. Watch for a break below 70 million. That would signal stress acceleration. A break below 60 million would trigger systematic concerns about delivery capacity for major contract cycles. The CME publishes daily updates. 4. Your local silver dealer premium on American Silver Eagles. This is the signal you can check yourself this week without a Bloomberg terminal. If retail premiums stay elevated or expand, while the LBMA spot price is flat or falling, the physical paper divergence is reaching your backyard. If premiums collapse, the paper price is winning the convergence battle. The dealer counter is where the thesis is most directly testable for retail. Now, I'm going to ask you 2 questions, and I want your honest answer in the comments. First, pick a silver price for August 31, 2026. Commit to a specific number, $90, $110, $140, or do you think the bears win and silver retraces to $65 or below? Drop your number. Drop the catalyst you think drives it. Don't hedge. Second, of the 4 signals, Shanghai Vault data, Shanghai LBMA premium, COMEX registered inventory, or your local dealer premium, which one would most clearly confirm the physical squeeze is accelerating rather than stabilizing? This question requires real thought because the answer determines what you should actually watch over the next 90 days. Now, what should you expect next? Expect volatility. Physical markets approaching binding constraints don't move in straight lines. Silver could test $74 again before reversing. Silver could spike to $85 and consolidate. The path is unlikely to be linear in either direction. Expect mainstream financial media to continue describing the vault drain as a routine market event. The narrative will lag the data by weeks. By the time the financial press acknowledges that Shanghai vaults have hit critical lows, the price will have moved meaningfully higher and the easy positioning window will have closed. And expect opportunity to appear in the brief windows when the paper price weakens while the physical data continues to deteriorate. Those windows are exactly the moments institutional buyers add to positions. The 2008-2011 pattern, the October-November 2025 pattern, and likely the current pattern all share the same characteristic. The best entries come when the chart looks worst, but the structural data is strongest. I'm not telling you what to buy. This is education, not personal financial advice. Your situation is your situation. But I'm telling you what's happening in the physical market right now. Shanghai silver vaults are at 992 tons, 31.9 million ounces. They lost 195 tons last week, 175 the week before, 146 the week before that. The pattern is accelerating, not slowing down. COMEX coverage is at 13.4%. Premiums are elevated. Industrial buyers are paying up. The 2010-2011 pattern, the 2020 pattern, and the October 2025 pattern all featured similar vault behavior preceding major price moves. Amateurs watch the price chart. Pros watch the vault data, the premium structure, and the EFP spreads. The amateur tape says silver is consolidating at $76. The professional tape says the physical market is approaching a binding constraint that the paper price hasn't acknowledged yet. Silver has been monetary metal for 5,000 years. Vault drains have preceded every major silver bull market in modern history. The patterns are documented. The mechanisms are known. The current drain is happening on the same schedule that previous major moves have followed. So here's the clean summary. Shanghai silver vaults are at 992 tons, 31.9 million ounces. They lost 195 tons last week, the biggest weekly drop since January 2024. Total 3-week outflows, nearly 500 tons. COMEX registered at 79.88 million ounces, 13.4% coverage. Shanghai LBMA premium at 2.5%. The 30-year Treasury at 5%. Ground beef at $7. The Fed voted 8-4 on April 29th. Kevin Warsh confirmed on partisan lines. JP Morgan's gold target at $5,000. Bank of America's silver bull case at $135,309. The structural drivers are intact. The vault data is the leading indicator. The price chart is the lagging indicator. This is where the serious holders of monetary assets separate from the tourists. The tourists watch one number. The serious holders watch the vault, the premium, and the spread. If you want the next breakdown, the moment the next weekly Shanghai data drops, the moment premiums widen further, the moment COMEX coverage breaks below 70 million ounces, the moment the physical squeeze finally hits the paper price. Subscribe. These shifts don't announce themselves on the channels that are paid to keep you looking the other way. Hit the bell so you catch the move before the headlines do. Drop your August 31 silver target in the comments. Tell me which signal you'd watch most closely, and I'll see you in the next one.